What if I told you the biggest portfolio mistake retirees make isn't taking too much risk, it's taking too little? The old rule of your bond percentage should equal your age is outdated and could leave you running out of money in your 80s. The smartest retirees do something completely different with their portfolios. I'm Josh, a partner at an award winning retirement focus firm, and I've helped over 500 clients build retirement portfolios that sustain their lifestyle for decades. Today, I'll break down exactly how to construct a portfolio that works in retirement, not against it. So let's get straight to it. Let's start with what most people get wrong. There's this belief that once you retire, you need to get conservative, sell your stocks, load up on bonds, keep everything in cash where it's safe. I see this constantly, and it's one of the most dangerous pieces of conventional wisdom out there. And here's why. When you retire at age 65, you're not planning for just 5 years. You're planning for 30, maybe 40 years. That's longer than most people's entire careers. Your money needs to last as long as you do, or potentially even longer. I'll explain that in a real client story towards the end of this video. And if you're too conservative, inflation becomes your silent enemy. It quietly erodes your purchasing power year after year. Think of it like packing for a cross country road trip. You wouldn't only pack snacks for the first 100 miles and hope you figure out the rest later. Your retirement portfolio, it works the same way. Just because you're retiring at 60 does not mean you're spending all your money on day one. There's still decades of life ahead. So here's a better way to look at this. You don't stop needing growth just because you stop working. The old rule about your bond allocation that we mentioned earlier, that's outdated. A 65-year-old following that rule would have only around 65% in bonds. And that means only 35% in stocks. That might feel safe, but it actually can be quite risky over 30 plus years. Because historically, bonds underperform against both stocks and inflation over long periods of time. Healthcare costs, those rise faster than general inflation. If your portfolio isn't growing enough to outpace those increases, you're slowly losing ground. Research from Dimensional Fund Advisors, some of the smartest minds in the business, show that portfolios with at least 65% in equities have significantly better long-term outcomes for retirees. Not just growth, but in sustaining withdrawals. The way you fund your retirement lifestyle over 40-year periods. Now, I'm not saying you should be 100% in stocks. That could be reckless. But maintaining a meaningful equity allocation throughout retirement is crucial. For most clients, we land somewhere between 50% to 80% in equities, depending on their situation. That might sound aggressive, but this isn't short-term money. This is wealth that you need to support you for decades to come. Now let's talk about something most people completely overlook, and that's cash. Most retirees think their portfolio should only be stocks and bonds, but cash serves a completely different purpose in retirement. It's your buffer, your flexibility, your secret weapon. Here's a general recommendation that I see work all the time. Have at least 12 to 18 months of living expenses in cash or cash equivalents. Not invested, just sitting in a high yield savings account or money market fund. And why so much? Well, there's three critical reasons. First, cash gives you flexibility for proactive tax planning. When you're doing Roth conversions, you need cash to pay those taxes without disrupting your investments. Second, cash protects you from bad timing. Imagine you retire in January and the market drops 30% in February. Without cash reserves, you're forced to sell investments at the worst possible time. But if you have a cash runway, you can ride out that downturn by letting your portfolio recover while you live off your reserves. Third, cash gives you permission to actually enjoy retirement. Those first few years are usually your most active, but if all your money is locked up in investments, you hesitate to spend it. Cash, it hopefully removes that hesitation. Here's where things get really interesting. Diversification isn't just important in retirement, it's essential. Most retirees I meet have portfolios heavily concentrated in US large cap stocks. Think the S&P 500. There's nothing wrong with these companies, but when everything moves in the same direction at the same time, that's where you have a problem. Because when you need to take a portfolio withdrawal, you have no choice but to sell whatever you own. True diversification means spreading investments across US stocks, large and small companies, international developed markets, emerging markets, growth, and value stocks. When you build a portfolio like this, not everything moves together. Some parts might be up while others are flat or down. And when it's time to take money out, you can strategically sell from the positions that are performing well. You're not forced to liquidate everything at the worst moment. Once again, data from Dimensional shows that globally diversified portfolios consistently outperform US-only portfolios over long periods. Keep in mind that long periods means 30 plus years, just like your retirement window. That's exactly what you want in retirement: options and flexibility. Here's something most people miss entirely. You don't build your retirement portfolio the day you retire. You start building it 3 to 5 years before you stop working. Think of it like training for a marathon. You don't just wake up one morning and run 26 miles. Well, maybe you can, but I certainly cannot. You prepare. Your retirement portfolio, it works the same way. During those final working years, this is when you build up that cash reserve, rebalance into a globally diversified portfolio, and start thinking about future tax efficiency. The biggest mistake I see is people treating their accumulation years and retirement years the same way. They're not. Accumulation is often just about growth. Retirement is about sustainable, strategic withdrawals while still maintaining growth. Let me share a story that illustrates exactly what I'm talking about. I worked with a client who came to us at age 62. He'd been working with an advisor who was obsessed with avoiding losses at all costs. Every time the market dipped, they'd move money around. My client, he was constantly stressed, always checking his accounts. And ironically, all that activity was creating more risk, not less. More trading means more taxes. More strategy changes means less consistency. So when we sat down, I asked him a simple question: how long do you want your money to last? He said he wanted to leave a substantial inheritance to his kids. That meant his portfolio's lifespan wasn't 20 years, it was 40, 50, maybe even 60 plus years. Once he understood that, everything clicked. We built a portfolio with 65% in globally diversified stocks, 25% in bonds, and then that rest of the 10% in cash reserves. We established clear decision rules for when to rebalance, and we stopped making emotional decisions just based on short-term market noise. His portfolio, it's grown despite taking regular withdrawals. That's the difference between reacting and planning, between guessing and following research. So, what do you actually do with all this? First, assess your current portfolio honestly. What's your equity allocation? Do you have exposure to the often unloved international and small cap stocks? Second, build that cash reserve. Start setting aside 12 to 18 months of living expenses. Third, if you're within 5 years of retirement, start transitioning to a retirement optimized portfolio. That means diversifying and thinking about tax efficiency. I recently did a deep dive on this exact topic, which you can check out after wrapping up this one. Fourth, stop treating retirement like it's a 5-year event. It's a 30 to 40 plus year journey. Quick question for you: what's the biggest concern you have about building your retirement portfolio? Here's the bottom line. Retirement doesn't mean you stop investing. It means you invest differently. You need growth to outpace inflation. You need cash to weather storms. You need diversification to give yourself options. The happiest retirees I work with, they're not always the ones with the most money. They're the ones with the most confidence that their plan will work. You've spent decades building wealth. Let's make sure that you keep it. Now you're ready to take this even further. Watch this next video to get ahead of most other retirees that are in your exact same position. Thank you for watching, and I'll see you in the next deep dive.